the Hexaware Technologies Limited earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Kalingara. Thank you, and over to you, sir.
Thank you, Stephen. Good evening to all of you. Welcome to Hexaware Technologies Earnings Conference Call. On the call today, we have Mr. R. Srikrishna, CEO and Executive Director, Mr. Vikas Jain, CFO, and Mr. Ram Singampalli, COO. As always, there is the full disclaimer in our press release and the investor deck. We shall take that as read. Any non-GAAP numbers mentioned are to be read in conjunction with the GAAP numbers. Please refer to the note which is included in the investor deck for that as well. Let me now invite Keech to talk about our results. Over to you, Keech.
Good evening, everyone, and thank you for joining this call this evening. This is one of the few events that almost feels normal in that we were always remote, and this continues to be remote yet. We had a slight drop in revenue in Q1, a little over 1% in constant currency, which kind of feels like a reasonable outcome given the circumstances. It does represent still a strong one-word growth of 17 or 18% depending on the currency. And this is after accounting for somewhere between a 2 and 3% impact, sequential impact on account of COVID. EBITDA, likewise, we had a decline of 80 bips. We would kind of call out the COVID impact of somewhere in the range of 100 to 120 bips. There's a lot of revenue loss that had little to no cost management effort possible. So it could have been higher. It's hard to call the exact impact, but it's in that range. You'll see in the next slide, slide number 5 for those who are seeing the slides, that ultimately up to the PAT level, things are roughly even with last quarter. But then there is a smart EPS growth primarily on account of Forex. Now, we actually had one of our best quarters for NN wins ever. We were actually on line probably for it to be the best quarter ever. And I said in the commentary we had a few weeks ago that month 1 and 2, Jan, Feb, we started the quarter really well. And we had a spate of wins and signings in Jan and Feb, and then it kind of came to a pretty sharp stop in March. But notwithstanding that, in aggregate, it was a great quarter with almost $70 million of NN wins. It could have been much better, but it was still a good quarter. Our closing headcount is roughly the same as last quarters. We did kind of pause on hiring towards the end, and we had a growth addition on freshers, so that portion of hiring still continues, and in aggregate we were flat. Look at slide 6 for those who are seeing it offline. This quarter was the first quarter that we have included in AS 116. So I will call out what the impact of that is on these numbers. At an EBITDA level, there is a 100 bps positive impact. At a PBT level, there is actually a 30 bps negative impact, which goes into our, ultimately our EPS. So that's the impact of India's positive at an EBITDA level, negative at a PBT level. So what you see here, of course, in this quarter, we also have kind of a one-off on RSU adjustments from a Q&Q perspective. Last quarter, we had a substantial one-off adjustment because it is the end of the program. So that leads to a little bit of the rough edge on a Q&Q basis on EBITDA post RSU. But our PAT after accounting for the India impact was flat in absolute numbers, and our EPS grew smartly, primarily on account of forex tailwinds. We've shown you a revenue walk on slide 7. We had forex headwinds. As bad as a quarter as Q4 was, Q1 was worse from a calendar perspective. We actually kind of got a little bit tailwind on account of mix and bill rates. But essentially, all of the drop came on account of volume. Actually, the volume impact is what could have been is even higher. I mean, there is a material volume drop almost entirely on account of COVID that caused the revenue to drop. In EBITDA, it's a little more complex. There are more factors at play. What you saw as a mix increase positive for revenue was a negative for margins. Calendar continues to be a negative for margins. We had utilization drop, which is actually 100% on account of COVID. In fact, the utilization would have improved. Remember, Q4 had substantial furloughs, and that shows up as a bad utilization. And to go down from there, you would actually expect to see it improve substantially, but instead it went down, and all of that was on account of COVID. We did actually have increments in the quarter. Now, of course, these increments were executed and given out before COVID became what it is. So they were done very early part of the year. And so that had an impact on, this is kind of the last kind of remaining cycle for us. We have multiple cycles. This is one remaining cycle. This is all of our on-site employees. So increments were given out early in the year for them. And then there were kind of other costs. This is the cost of actually managing the COVID itself in terms of could we work from office, all the incremental costs to ensure seller health for our employees. We also had a kind of client going bankrupt. That's partially COVID, but we put it under here for now. So those were some of the major puts and takes on EBITDA for this quarter. I don't have a commentary on GAAP to non-GAAP recon. It's the same as what we've been doing for the past number of quarters. We've adjusted for amortization of intangibles and the NPV of deferred payments. The NPV of deferred payments has come down, and it will come down further later in this year. I again don't have specific commentary on depth of customer relationships. The trend is what you've seen for the past many quarters, that across each customer bucket, we have more clients, and our client concentration risk has come down substantially. And at this point, what used to be our top 5 clients, maybe 1.5 years ago, giving us mid-40s% of business, is now coming from our top 10 clients. Now, I actually said we had a great beginning to the quarter in terms of new deal signings. Actually, the full strength is not even reflected in the number. If you recall, I said there is a shift in strategy to also, focus on land and expand in high-quality accounts. That land and expand strategy does not immediately show up as a large booking, but it, is highly valuable to us nevertheless. And so actually, there's actually quite a slew of new wins in the early part of the year. And while Europe has been on a roll for some time, and you'll see that reflected in Europe numbers, we had made substantial investments in ramping up and redoing our U.S. hunting. And many of you may know that actually we have VC who used to run our infrastructure business also take over an additional role of running and setting up or rejigging the US and hunting. Now, that investment was beginning to pay off, and we saw quite a number of wins in the early part of the year. But like I said, it's gone on pause mode right now. More on that later. So one of the positive kind of fallouts of the situation is that attrition fell down. I mean, we've been trending downward on attrition for a number of quarters, and that is through a concerted set of investments and efforts. That trend continued, but there was a little bit of a sharp drop-off in March, so we actually expect to see this go down quite a bit further in coming quarters. On the other hand, utilization went down. We expect it to go down quite a bit further in Q2 and start getting to normal in Q3 and Q4. And we'll talk a little bit more about what our strategy is in the case of COVID, but as it pertains to utilization, I think our primary focus is, once we get past safety of employees, the next focus is how do we continue to maintain and improve on trusted relationships during this period with customers. And if that means short-term dip in utilization, so be it. Some commentary on geographic, vertical, and horizontal cuts for the quarter, but also later on I will talk about what we see as some of the trends in this going forward. You will see here that kind of APAC had the first impact and the full quarter impact. Europe also had an earlier impact than North America and almost a full quarter impact, but yet there was a lot of other underlying strength in the Europe business because of which it still grew. North America had the latest impact, the last impact from a geo perspective, but it is in many ways the sharpest impact, and that impact will carry through into Q2. From a vertical perspective, there's a couple of our verticals that actually grew through this quarter, and we actually expect to see that strength going in to Q2 as well, at least. BFS and HTTPS. BFS, this is, I do want to relate this back to the top, one of the top clients commentary that we've been giving for many quarters. What we said last time is that client, we've seen the bottom in December. Q4 to Q1, there will be a quarter-on-quarter drop, but a month-on-month increase in volume. So both those are true as we speak. There was a quarter-on-quarter drop, which was anticipated. And so this growth in BFS that you're seeing is despite that. But there is a month-on-month improvement in that client in business volume, and actually we expect to continue to see growth in that client. I will kind of come back to providing some color on what we see going forward on a vertical basis in a few minutes. For now, I'm just sticking to what happened in Q1. On service lines, there was a pretty uniform hit. I think it's kind of going to be hard to predict the impact of short-term impact of the COVID situation on service lines. It's going to be a little bit all over the map. There's three things I would call out here. One is that our digital, we have three portions of digital: automation, cloud, and customer experience transformation. The customer experience transformation component of each of our businesses which you don't see here reported this way, but that actually continued to shine, including the acquired business from MobiCredit and the organic business. The second thing is that, IMS, you're seeing a sharp drop that's actually attributed to two reasons. One is that the large client we just spoke about, quite a substantial portion of that is on account of IMS. So that, in fact, we've been seeing for a few quarters now. In fact, the big component of the Y&Y impact is due to that. In addition, if you recall, we spoke about consciously pivoting the IMS business to high-end project and consulting work, which gives us higher margin. But that, in some ways, was amongst the first businesses to get paused. Capital projects, either because that's a budget priority, but also in many cases because we cannot implement that work in a shutdown situation. It's not supply side from Hexaware, but from the client side, they don't have employees in offices to execute those projects. So, on the other hand, we do think that immediately coming out of COVID and almost a V-shape, this business will recover. And both cloud and work from home will be actually strong positives for the IMS business. So you will expect to see this coming back up very quickly. Now, normally we would have kind of, at this point, just provided an update on guidance and spoken about financials, but I'm going to take a few minutes more to talk about operationally how we have done and what we expect to see as a consequence of COVID in aggregate, but also some commentary on verticals and service lines. We spoke about this last time. I think we set out with three objectives: ensure safety and well-being of our employees, deliver exceptional services, and contribute to community where we can. And we've done very well across all of those fronts. We transitioned to work from home a week before the Indian government called it in India. And in almost all places around the world, 2 weeks before the Indian government, if you use that as a timeline. So we were kind of work from home before any government mandate in any country. And on IT side, we were, within the first 3 working days, we were close to 100%, and we continue to be so. The last % or two that we were not moving is not on account of us, but on account of client permissions. BPS, on the other hand, the client permissions and sometimes the nature of work is more challenging to do work from home. And so we were, from a revenue perspective, about 75% coverage. By end of March, today we've improved that to about 80%. And the revenue impact I spoke about for Q1 included some supply side issues, especially in the last week, and a lot of that came from BPS. Now, we actually did customer satisfaction survey. It's an agency that also does for the industry. So the outcome is basically that our customers were extremely happy with what we did. And actually, we have a couple of slides for you to look at offline, but I will call out to slide 16. Mike, if you can go to slide 16, and we'll come back to 14. This is kind of the outcome of the survey. The right is what we had commissioned, and the left is what this research agency had done on their own in terms of an industry survey. And while I think in aggregate, most customers were very happy with how all the entire industry handled ourselves, with only 3% being unhappy. What you see is a material difference between what percentage of clients for Hexaware were very delighted So there's a full, almost half of our clients were very delighted with only 28% for the industry. So we did actually quite a bit better than us, better than the rest of the industry. What our strategy is that when if and when in India the government lifts the lockdown and same in other countries, we are actually not going to be led by government policies. We're going to be led by employee safety. We're going to be led by what does it take for us to deliver a robust and resilient service to our customers. So we anticipate in the short term a very small percentage of employees coming back, and that will happen in a very staggered approach with many protocols in place for ensuring safety. In fact, we foresee a scenario where up until the point where there is a widely available vaccine or treatment, we may be on about half employees working from office for a fairly longish period of a year or more. And we think that in that way we will ensure we'll meet our dual objectives of ensuring continuity of service to employees under most circumstances and ensuring health of our employees. Now, I do want to provide a little bit of commentary on what we expect to see going forward. Q2, the current Q2, we think will be the worst. So a lot of impact that you're seeing is essentially last few weeks of Q1. That will have full quarter impact in Q2, in some cases worse. Some industries, the second order impact in industries will start coming through in Q2, and some of that actually will spill over into Q3. Recovery will be staggered. Some industries will recover fast. For example, you're seeing a drop in HNI for us. HNI, we think, kind of medium term is positive. But there were, unanticipated kind of stoppage of work in our customers' industry. For example, no clinical trials are happening right now. So very few because of social distancing now. And that will resume. In fact, it may resume with a vengeance immediately after shutdown. So it will be a pretty sharp, potential V-shaped recovery. So different industries we think will kind of take different paths. HNI will have a sharp recovery. GTT will be the longest impact. Some pockets of our manufacturing and consumer business will have a longer drawn-out impact. Retail, some portions of manufacturing, a little bit of automotive sector, all of those are going to have longer-term impacts. Excuse me. BFS are, if you look at our sub-segments, asset servicing, asset management, mortgage, banking. Asset servicing usually sees a net positive because of increased focus on cost and outsourcing. So asset managers outsource more to asset servicing companies. And so usually we see higher volumes of work in the medium term in asset servicing. Mortgage, we actually expect to see both of our customers in that space, and both of whom are material, actually do quite well. It's different from GDC in that there is a lot more liquidity in the system. There has been a lot more speed of action on that front. So we don't actually see necessarily a mortgage crisis at this point. And so actually there is a lot of refinancing work and the second order impact, but there is actually potential volume increases in the mortgage business. And we actually expect to see that for the rest of this year. On asset managers, we think there could be a little bit of a delayed impact in Q3. They tend not to make immediate decisions, but they're going to wait and watch to see their asset prices settle before making decisions. Our HTPS business, we think, will continue to do reasonably well through the year. There will be potentially some impact in Q3, but a lot of these businesses are transforming, investing in technology to transform their core business, and that's where our play is, and that will continue. Some commentary on horizontal services. We think kind of digital as it pertains to all of our themes on digital, which is customer experience transformation, cloud automation. All of these we think will get renewed and urgent focus. Customer experience transformation, I know a lot of people think of it as discretionary spend. That may be true in some pockets, but actually for a lot of clients and a lot of industries in today's context, it's almost a business continuity issue. And the easiest to understand that is in the context of restaurants. Restaurants today in many parts of the world are not allowed to dine in, but they can do curbside delivery. And unless they have bare minimum digital capabilities, their revenues will go to zero. So it's really a business continuity issue for them to build and develop digital capabilities. And we think that will be a sustained trend to help our customers deliver touchless and yet immersive experience will be, we think, a lasting impact of COVID. We think to enable to do that, people have to move rapidly to cloud and leapfrog digital customers that have taken digital transformation, internal IT and slow pace, we think will accelerate that. And we also think that automation, which has been on slow pace, will get a boost because that is the most sustainable way of cost reduction, which will be a huge imperative for all of our clients. And finally, we think that, we're calling it anywhere employee. The concept of an anywhere employee will be here to stay post-COVID. It could be 30-40% across a wide cross-section of industries, some more, some less. So we think a third to a half of workforce will continue to work from home, and that gives rise to a new set of opportunities and challenges post-COVID. Finally, on guidance, much like everyone else, we are suspending guidance for the year. There's a lot of uncertainty about the recovery paths across industries. Like I said, in aggregate, we do expect to see it coming back to kind of pre-COVID levels, the volumes in 3 or 4 quarters. But there's uncertainty, and so we are, for the current period, for the current year, suspending guidance. With that slightly longer than usual commentary, I'm going to turn it over to Vikas for some additional commentary on our finances.
Thank you, Keech. Hello, everyone. Hope all of you and your families are safe. A view of the numbers in INR terms. In rupee terms, revenue for the quarter was at 15,418 million, 15,418 million, a sequential growth of 0.8% and 22% year-on-year growth. Growth in rupee terms was stronger, driven by dollar strengthening during the quarter. Update on the hedge. We continue with our layered hedging policy, wherein we take forward covers up to 24 months in advance. As you can see, our US dollar forward cover rates are improving quarter after quarter, which is good. As of March end, we have a total forward cover book of 236 million, with a majority of the covers in US dollars and some of them in GBP and Euro. In terms of the forex gain or loss, the chart you see here has a 6-quarter view, which gives the 4-quarter view in terms of the actuals and then also forecast what we expect the next 2 quarters to look like. For the current quarter, for Q1, we had a gain of $5.8 million. This was primarily driven by translation of monetary assets held in foreign currency and converted at the period end exchange rate, which is the March closing rate. There was also an item with respect to the gain or losses from hedges, which went into it, but significant chunk of the gains, what you see here, was all translation related. For the next 2 quarters, we in fact have different scenario. We are expecting gains in Q2. We are expecting losses in Q2 and profits in Q3. And this is purely a function of the rates at which the forward cover for this periods had been taken at various points in the past versus the March closing rates. And as you must be aware and you'll be tracking, that rupee has depreciated significantly compared to the US dollars over the last 6 weeks. And hence there's a bit of a disbalance in terms of where we think we are going to be getting a gain versus a loss. Moving to a few balance sheet items. The cash generation in the quarter remained very strong, and the total cash what we have on the balance sheet as of Q1 end was 58 million. We had a strong cash conversion, and our OCF to EBITDA for the quarter was at 73% versus the 68% from the last quarter. This is after we paid $30 million to the Mobiquity shareholders in January of the current quarter in line with our deal agreement. DSO, including unbilled for the quarter, is at 82 days, marginally higher than last quarter. Now, during these times, our clients are looking for partners who can help them tide over the crisis, and we are working with them on multiple fronts, one of them being extending payment terms. And we are doing this on a selective basis for few clients, and not for, or I would say for the clients where we have a very deep relationship and we expect that relationships to continue even flourish even in times to come. We expect the DSO to go up in the next 2 or 3 quarters before it starts coming down back to the normal levels in line with what Keech explained as to how we think that the business is going to perform over the next few quarters. Our ATR for the quarter was at 18.6%. Our base ATR for the next 3 quarters continues to be at 19.5%. On CapEx, we continue to invest in our business. Some of the investments what we did in the current quarter was in terms of PCP preparedness with respect to the COVID. Our total CapEx was $4.5 million, almost in line with the spend we have had in the past few quarters. One final comment on dividend. For the final dividend that was declared in Q4, we are on track to pay that subject to approval at the AGM. We will be holding our AGM once the lockdown is lifted. For the current quarter, no dividend has been declared for now. We are holding cash to work with our customers and partners during these times. However, we will continue to evaluate based on the ongoing performance of the business and based on how things evolve, we'll make a decision on dividend payouts in future. With this, we'll now open up for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sandeep Shah from CGS CIMB. Please go ahead.
Hello. Hello.
Mr. Sandeep, you may go ahead. Your line is in talk mode.
Yeah, so you can hear me, right?
Yes, sir.
Yes, Sandeep. Yeah. Thanks for the opportunity. So just the first question, looks like the impact on the revenue growth of 2 to 3% for 10 to 15 days of a lockdown seems slightly higher. So it looks like the impact is not just from supply side, but also demand side. And as you are saying, the Q2 would be the worst. So if for 10-15 days of lockdown, the impact being 2 to 3%, one can say there could be a very significant Q-on-Q dip in the revenue could be possible in the Q2 as a whole?
Yeah, I don't think there is any correlation between there is a very small correlation between the lockdown period and the revenue impact. So, majority of our revenue impact was on account of demand. There is a small portion, primarily in our BPS business, that came on account of supply. So really, there is not a strong correlation between those two factors.
Okay. But when you say 2Q CY20,
I mean, just to recall, we said 99% of our IT business has been in work from home before the government announced the shutdown. And we started 25, and now it's 80% coverage on revenue for BPS business in work from home. So in the BPS business, there is still some supply side impact, but that's a kind of that's not the huge. That's why I said there is a weak correlation between number of days of shutdown on our revenue.
Okay. And sir, regarding the April, May, June quarter, some of your large peers have indicated that the kind of declines which the industry has seen during the GFC slowdown, which was anywhere between 4 to 6% Q-on-Q dip, could be the possible decline which may be possible this time as well. So I'm not asking for guidance, but do you believe that's a right assumption, or do you believe because of your portfolio mix, the impact could be even bigger than that?
I don't think, we will be any worse than the industry, right? If at all, we will be better. And I don't want to use this opportunity to address the different topics that I intended to provide commentary on. I know there is some commentary, and we spoke about this last call too, in the end of the quarter, that there is some commentary and perception that companies like Hexaware, there is a higher consolidation risk. Actually, we see exactly the same opportunities for market share gain that you heard from the commentary you heard from some of the other peers, the larger players. We see the exact same opportunities. The most important opportunity at this point of time with clients is to gain trust and goodwill. And the best demonstration of that for us is in our customer delight service. And you saw data that our performance, the industry's performance across the board is pretty good. But notwithstanding that, ours was materially better. And that is the basis on which we actually expect to see, not overnight, we actually expect to see market share gain opportunities. So what all that means is we're definitely going to be no worse than the industry.
Okay, that's fair enough. Just last few, Keech, because you get 10% of the revenue from travel, and last time you also said the education and the fitness business may also have a slight impact. These three segments as a whole, so are you worried about major client-specific issues in the coming quarters? And second, on the EBITDA margin, the last time the guidance which you have suspended, you were looking at 15-16%, and the first quarter is at the lower end. So there could be some puts and takes on the margin. There would be some headwinds, some tailwinds. So any commentary in terms of how the margin will look like at a current rupee dollar, because there is a possibility of a wage hike deferment which may be there for the whole of CY 2020 as a whole.
So on the first question first, we don't have large customers in our travel business that we see any risk in. All of our large customers are, we think, large either and systematically important to either the industry as a whole or the countries that they serve. The national carrier sites are equivalent to that, and we just see no risk in business continuity for those clients. There are some smaller tail-end clients where there could be some risk to their continuity, but it's not going to be material to our business in case. We had one client going bankrupt this quarter too. And actually, part of the revenue decline is not an in-quarter impact of the bankruptcy, but because we've written off a bunch of money. So some of that may happen, but these are smaller clients. The larger ones we see no systematic risk. On your second question on EBITDA, what are the puts and takes? I think the biggest kind of short-term headwind is utilization. I do think utilization will catch up in Q3, potentially substantially, definitely by Q4 fully. On the other hand, we will have some costs that are natural saves as a consequence of what's happening, travel, transport, some facilities costs that we otherwise incur. On the other hand, we have some and wage increments, postponement or delays or non-payment of wage increments. These are all kind of potential improvement and tailwinds. The biggest, aside from utilization, the other big headwind is the fact that customers are looking for cost saves in this period. Much of it is temporary in nature, but the temporary could mean 1 quarter, 2 quarters. In some industries and some customers, it could be a little bit longer. And I think kind of that is going to be a headwind for a margin. Where all of this shakes out, we will see. Q2 will definitely kind of be a dip. We just have to, because utilization, I think, will be the worst hit in Q2. And, concessions we make to our customers will also be the maximum in Q2. Like I said earlier, our goal is to use this period to build and sustain and strengthen our relationship with customers. Because this period will pass. And once we are done, who grows with customers is the people that have worked with customers during this period. And that is exactly where we want to be. So that's, those are the puts and takes that we see. The big headwinds, utilization and concessions to customers, and some of the things that will help us are natural cost saves.
Okay, fair enough. And just a last question, if I can squeeze on the dividend, for conserving cash, would be a full year scenario of CY20 where we may not announce any dividend in the next 3 quarters, or this is just as of now we have took that decision as a whole. And all the best and stay safe. Yeah.
Thank you. It is as of now, and even this quarter we may revisit later.
Okay. Thanks and all the best.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Thanks for taking my question and hope you're keeping safe and well. So, Keech, my question is more on the medium-term aspect of your strategy on client mining versus hunting. Now, the context is that key success has been in client mining, which is reflected in that 5 to 10 billion bucket. And also in the current scenario, we're hearing more of vendor consolidation, as you also alluded to. Now, juxtapose this with the fact that NN wins have been probably the best ever, and which is also corresponding with increase in the net addition of clients. So, how should I really look in terms of your strategy of mining and hunting, putting all of this in context, as well as the land and expand strategy that you talked about?
See, we think of these as multiple engines firing, right? So, a 6-cylinder engine is going to do better than 4, and an 8-cylinder is going to do better than 6. So while our mining strategy was working really well, I think our hunting had fallen behind, especially in the US. It was doing well in Europe, it was doing okay in APAC. US had fallen behind, so we really were cranking it up. And I think, it would have given us, sustainably additional growth once we got to kind of full performance on that front. And we saw early evidence of it in the first part of this quarter. Unfortunately, I think it's going to kind of pause, and we're going to rediscover how to kind of effectively hunt in this period. We've already developed, for example, a touchless transition methodology and a touchless go-live methodology, and we have multiple examples, even in the last 4 to 6 weeks, of touchless transition, touchless go-live. But yet, there is a pause, and so we have to see how fast it comes up. I think in the long term, we will continue to think of it as multiple cylinders, all of which will contribute to growth. We will continue to have focus on existing clients, but we made additional investments to also then focus on hunting, both for deals, but also for land and expand in important brand names.
Got that. And Keech, also on the client concentration side, which is significantly reduced over the last 1 year or even 3 year period, including the drawdown impact from the large BFS account. So how should, again, more on a medium-term basis, should we look at the client concentration? Is this the new normal, or do you see this changing meaningfully, further? And just one more, if I can squeeze in along with that, is what percentage of your revenue, from clients do you see as systematic risk that you called out earlier in terms of potential bankruptcies?
Yeah. So on the first question, I think kind of directionally this is the new normal, right? I do think, though, there will be some kind of in the next few quarters, I think we will kind of see it creeping back up, the concentration, because I just portfolio specific. I know the accounts in there, and I think they're going to do better in the next 1 year than the rest of the portfolio. So you will see it kind of going up a little bit. It's not going to come anywhere close to what it used to be, and then it's going to stay there. Systematic risk, I think it's early to assess. I mean, there'll be some, right? Retail, potentially some small travel clients, but it's not, clearly we don't think of it as huge. Otherwise, we would have had a more specific number. We don't think of it as huge, but it does exist in pockets.
Got it. Thanks and all the best.
Thank you. The next question is from the line of Vimal Gohil from Union Asset Management. Please go ahead.
Yes, sir. Thank you for the opportunity, and hope all of you are well and safe. Sir, I just wanted to understand once again on this sharp decline that we've seen in IMS. While the earlier understanding, or rather my assumption, was that maybe IMS could have a lower impact as compared to other service lines. Because, as you said, you're already working remote. Could you just probably give more detailed slightly more detailed outlook on how can IMS pan out? Because one, it has been a major growth driver for you, and so I mean, what's the outlook there? And as far as your margins are concerned, given the fact that you are going to see accelerated sort of pressure on your revenues in the coming quarters, do you see margins falling further? But are you still hopeful that you'll be able to regain those 13.5% EBIT margins in the medium term? These are my two questions. Thank you.
So on margins, I will do that first if you're okay. We just called out all the positives and negatives, right? So we said that there is going to be utilization, but the headwind in the short term, utilization will catch up during Q3, will catch up fully in Q4. Customer concessions are going to be a headwind, and that recovery is going to happen in a staged way, different cycles across different clients and industries. And we'll have some saves on a bunch of business issue cost, transport, travel, utilities, etc. So where all of this will kind of end, I think we will catch up with the normal margins in 3 quarters, 4 quarters. That's a base scenario. It could, under some very optimistic assumptions, it could be earlier. If things go really bad, it could be later, but I think a base assumption is in 3 to 4 quarters, we'll be back to business as usual, both from a volume and from a margins perspective. On IMS, I think there were 2 separate things happening for the past, which is one particular account. There was an impact. There was a good chunk of that impact was in the IMS business. It's also that a lot of what we do in IMS now is consulting and project work, which means, big projects on migration to cloud, for example. So that always tends to be a little bit spiky and lumpy, if you will. But on top of that, I think there is a major stoppage of work in many pockets. That is not reflective of what we think will happen going forward. We think going forward, both as a consequence of migration to cloud and as a consequence of increased work around work from home, we're calling it the anywhere employee. Both those will be positive tailwinds for the IMS business, and we do expect to see it coming back to growth pretty quickly, even in Q2.
Fair enough, sir. All the best. Thank you very much.
Thank you.
Thank you. Next question is from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
Yeah, thanks for the opportunity. Just one question on, you indicated about credit period extension and pricing discussion. Can you provide any incremental detail how significant it could be and whether it can be recovered, whether it is short-term kind of price negotiation which are happening, or you expect it to be having implication over medium term? Both the things, credit period extension as well as pricing. If you can provide some color, that would be helpful.
I think both those will be short-term. We've not seen a single instance of a client where they're using the situation as a leverage to get concessions which are not in line with their business situation. So all the discussions happening are short-term in nature. Now, what short-term means in of itself varies by industry and customer. It could be a quarter, 2. In some rare cases, it could be for longer, right? But it's all short-term. The credit extension. Ultimately, I think the aggregate impact will be a single-digit number of days increase in DSO. That's what we think the aggregate impact will be. So there'll be some clients where we do more, but that's what we anticipate, a few days increase in DSO. And we'll be fine with that. And we're obviously going to be careful about where we do that, where we expect a systematic risk. We're going to be a lot more careful. Where we don't, it's going to be an easier discussion with clients. On discounts, I think it's a more complex conversation, and what essentially, the focus for us is, client asks for a discount, and how do we demonstrate that we're willing to share in the pain, but also then show the pathway to client for how they can save a lot of money. And saving that lot of money, some of that will translate to potentially additional business for us. And so that's the strategy. It's not new. It's what everybody else will be doing as well. It's what the industry did in 2008. But we think there are real opportunities in pockets for us to gain business volume, even if there is a concession for a period of time. Coming out of it, we will be coming out of it with higher volume, with what was a depressed price and the rearview mirror, and then once the price returns to normal, we'll be in a better situation.
Okay, and just last on the bankruptcy you suggested. So first is about whether we are seeing any challenges in our top 10 10, 20 client, and the bankruptcy is whether it was any significant client for us. Thank you.
So the answer to both those questions is no. So not a significant client. We don't see it as in our top 20.
Okay. Thank you.
Thank you. The next question is from the line of Sudhir Guntupalli from Motilal Oswal Securities. Please go ahead.
Yeah. Good evening, gentlemen. Thanks for giving me this opportunity. Regarding your commentary on the two top clients in the secondary mortgage segment, one of these entities seem to be sounding caution and looking forward to hand-holding from the government at this juncture. Many news reports also seem to suggest that these entities may need government bailout if COVID-19 situation remains bad. So what gives you confidence on this segment overall, and especially on the assumption that the worst is maybe largely behind in the top client where we had been seeing headwinds due to internal restructuring even before COVID-19?
Yeah. I think in that client, first off, we have evidence of month-on-month increase up until this point of time, which includes through COVID and through the COVID situation, right? So we have clear, we know that there is, we were expecting beginning of the quarter to see month-on-month increase. That happened, but that also continued through COVID. So that I think is the first and most important piece that gives us confidence. I don't think the country has learned, U.S. has learned its lesson in terms of what interventions are needed to prevent a mortgage catastrophe. I don't think the country can afford a mortgage or a housing issue on top of everything else that's happened. I just don't see it happen. And yes, I know that at some point of time, depending on how many millions of households default or delay payments, these firms may need additional balance sheet help. But if that situation does arise, I think the government will provide it because, why would they not? They know what the solution is. They've been through this before.
Sure, sir. And my second question is on balance sheet to Vikas. There was a strong increase in cash and cash equivalents during the quarter. A part of it might be due to the improved cash conversion. But the borrowing has also increased by almost 260 crore. So is this borrowing? Have we borrowed more to conserve cash on the balance sheet during tough times, or any more color on this front will be helpful?
No, I mean, so let me answer it in this way. The cash and cash balance has gone up from 35 million to 58 million, which is an increase of $23 million. It's primarily all on account of operations. The debt balance went up from 20 to 53, so which is close to $33 million. But as I mentioned, during that quarter, we paid a $30 million of installment, the first installment which was due to Mobiquity after the initial one. So the increase in the debt balance was primarily towards paying the Mobiquity installment. So it has nothing to do in terms of shoring up the balances on the balance sheet and at the March end. So it's primarily all driven by cash from operations.
Sure, because and that's it from my side.
The other aspect which also helped is we had declared the dividend. We were expecting to hold an AGM, but obviously because of the lockdown, the AGM has not yet been held. So there has not been a dividend payout, which you generally see in each of the quarters.
Sure, understood. Thanks and all the best.
Thank you. The next question is from the line of Madhu from Centrum Broking. Please go ahead.
Yeah, hi sir. One on the work from home, we are saying that it could continue for a prolonged period of time, and a possible disruption can happen in this delivery model. So your views around that, because we have been proactive on the automation to gain market share in select service lines. So whether this can be a disruptor for you to take advantage and build a new delivery model around that.
So the short answer is yes. We actually think that the disruption will come not just from work from home, but the moment we have essentially the set of technologies in place to ensure not just a productive and engaged employee, but also delivery platforms to ensure that we can deliver services effectively in work from home. The moment we have that in place, I think the real disruption will come from enabling gig workers through the same platforms. And it just expands the workforce to include many demographics that would have otherwise sat out of the workforce. It expands our geographic capabilities, and it alters the economics of the industry. It brings in a lot more variability. On one end, it increases the talent availability on the other. So it's not just work from home. We think that there is also a big shift to gig workers in the IT space and BPS space that is coming.
Yeah. And second one on the Mobiquity portfolio, how is the utilization there? And for us, the balance sheet is having very minimal net cash. So when the working capital expense, even larger vendors are saying that, because of their strong cash position, they will be able to give favorable terms. So how we will address this? Because our net cash is very minimal, net of debt. Thanks.
So, Mobiquity, like I said, we think that a lot of the customer experience transformation work is not necessarily kind of discretionary that it gets stopped. It is now an integral part of the business. As an example, one of the quick service restaurants and retail chains that we service, their overall business volume is down dramatically, but ordering through the mobile app we built is up 90%. So that is a good example of how this is actually business continuity. It's not some pet project. On the balance sheet, I will ask Vikas to respond.
Okay. So when we did the Mobiquity acquisition, we had planned to fund the deal through a combination of internal resources and through a credit line. And we had announced at that point of time that we have taken a credit line which is close to $50 million for us to fund it. Until now, we were not drawing down because we were doing really very tight management of our funds. And at that point of time, there was no need for us to draw down on the lines. So even now, there was no need for us to draw down on the complete lines, but we went ahead and did that to pay the first installment, primarily because of the reason we know that during these times we have to partner with our customers and with our vendors in terms of working with them to help them mitigate this crisis and come out of it stronger, which might include some of the items like price discounts and EPT, extended payment terms. So I get the point while you are looking at it in terms of the cash balance is net of debt, but even on a pre-COVID basis, we always had done a business planning which assumed that we are going to be having a debt on our balance sheet for a few quarters to continue till the time the Mobiquity deal was totally complete. So we will continue to have this debt on the balance sheet, and from a working capital perspective, I think we have enough resources which are available on the balance sheet with a $50 million plus to work with our partners and our customers in terms of extending the support what is required. So the net summary is I don't think we are going to be disadvantageously positioned compared to any other player in the industry in terms of partnering with our customers during this time.
And cash on the balance sheet is cash on the balance sheet. That is how we got to the cash, but it doesn't detract from the cash in any way.
Okay, sir. Thanks.
Thank you. Next question is from the line of Smith Rastogi from UBS Asset Management. Please go ahead.
Hi. Just one quick question. Would you be able to comment on the US dollar bond at the holding company level, which is coming due next year, like any refinancing plans or related comments on that particular bond?
What about it?
Sorry, can you please repeat?
Hello, I'm not
Mr.
sure.
Rastogi. Mr. Rastogi, can you repeat your question, please?
Yeah, my question is that there is a US dollar bond, offshore bond, which is coming due next year at the HT global level. Can you please comment on any refinancing plans for that bond or any related comments on that?
So, two things. First is that it is a question best addressed to the bondholders, which is not Hexaware. The bondholders are bearing, bond issuers are bearing. The second is there's plenty of time, and Bearing has strong and deep relationships with capital markets around the world, and they've done this many times over, and there's plenty of time. But it's still a question best addressed to the bondholders. I'm sorry, the bond issuers.
Sure, thank you.
Thank you. As there are no further questions, due to time constraint, I now hand the conference over to Mr. Vinay Kalingara for closing comments.
Thank you all for joining the call. We'll see you on the road virtually. Thank you.
Thank you. Ladies and gentlemen, on behalf of Hexaware Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.